Hello, everyone. Uh, yeah, welcome to today's session. Sorry, I have to put off the camera due to some reasons. Yes, but that notwithstanding, we still have a very smooth session by God's grace. Yeah, I would like to know if you can hear me. Yes, if you can hear me, please let me know. If you can hear me clear, let me know, please, so that I can proceed with today's class. We are lagging behind those days that network fucked up. It's really dealing with us. So we need to move very fast. So if you can hear me, let me know. All right, thank you, Omale Abib. Yes, while we wait for others, there's absolutely no time to wait. So we'll not wait for them at all. We'll just proceed. They will catch up with us. They will catch up with us by God's grace. So yesterday I was talking about this topic, spot trading and fundamental analysis, and how what are the things you should look out while doing your fundamental analysis. These are the things I was learning about, I was talking about, and God helped us to establish some facts that okay, these are the things you should check while do your analysis, your fundamental analysis. You should check the trading and liquidity and trading volume. You should check market cap. You should check circulating supply. Now, this supply is like some people had confusions about it. Now, what's the this circulating supply is the amount of the coin that is available to the public that people can actually buy and sell. Now, while total supply is the total number of the coin in existence. Do you understand? That is it. Now, that maximum supply can reduce based on the fact that they can burn. There's something called token burn. When you burn a token, that means they remove it from existence. But they cannot add to it. It's not possible. I don't know. It's not possible to increase it. You can only burn it and reduce uh, the the stuff. So that is that. I gave you guys assignments. Only three people submitted the assignment. I gave you a coin to analyze on. What I just want you to tell me about the coin is okay. Oh, this also coin. Oh, I checked the market cap and this is the value of the market cap, showing that the coin is maybe is it can still grow or is too dangerous that it can slip to zero. I need to know that. So um I need to know the liquidity, how much are people trading it. You check for the exchanges that the coin is available on. From there, you can see the 24 hours volume of all of the coins on those exchanges. So you'll be able to know how liquid it is, then the trading volume and everything. Then you check the circulating supply, how much of the coin, how much of the coin is in existence. You need to know all these things. These are the things I want to hear. But some people got it correctly, did well. Then you need to run the background analysis, check the CEO of the company, who is the owner of the coin. Then you check the project metrics. What is the coin doing? Do you understand? Our time, we don't have time at all. I would have said, okay, let's do that together. But there's no time at all. So I wouldn't go through that. Who is disturbing the chat box? All right. Now I want you to check the crypto white paper. There's white paper on their website. Immediately you open their website at the top of the site, you will see white paper there. So you can click on it and you will see it. You download the white paper for you. I think I downloaded it earlier today. You download it for you and you will see it. Let's just brief the coin. Let's brief the coin together. Um, we'll just spend like 2 minutes here. Okay, where's that search button? This is sick. seek VR. This VR means virtual reality. You can browse, you can search about what VR means. VR means virtual reality. It's just like all these 3D stuffs, these things. These are what they call virtual reality. When you put it on, you'll be feeling as if you are inside. For example, if you are using this thing, this stuff to watch movie, you feel like you're inside that movie. If you are using it to play a game, a video game, maybe combat game or car race or something, you'll be feeling like you'll be seeing yourself as if you are inside the game. So that is what VR means. So this this is one of the things they are working on. So you just that means this coin is related to that. That's a new technology somehow, a new not new like that, but it's just getting ground, it's just getting popularity. So that is first green light for me for the coin. Then the next one, you go to their website, you can check the coin supply. Can you see the circulating supply is even less than 1 billion? That's very nice. The total supply is just 1 billion. 1 billion coin. That's also very nice. So you can see the 24 hours volume is $13 million. That's not bad. That means this coin can easily go up. See, sorry, see the market cap just around 80 something $1 million. That means this coin can easily go up. It can easily go up. And this is big. This $381 million is at least not too small, such that we can now see this coin can go to zero. Do you understand that? So that's another thing. Yes, if you go to their website, you will see the white paper I'm talking about. So this is their website. See, look at the white paper here. This is the white paper here. You can check it. So these are the things I want to see. I don't want to waste time on this because our time is limited. See, this is the you just wait for it to download. It's going to so you can download it if you want to. So you will see exactly what they are doing, and on the website you will see seek directly connect music artists, athletes, and other digital content creators directly to their fans in virtual world. So this is just like an introduction for the when you read more, you will see what the project is all about. So it can help you to know what you want to do about it, whether you are going to invest in it or not. So now we'll continue from where we stopped yesterday. Um I think this is where we'll stop. No, this is not where we stopped. We enter technical analysis, and yes, this is where we stop. Now, we're now introducing ourselves to what future trading is. And yesterday I defined it. I defined it and I defined it and I said in future trading you can make money when the coin is going up, and you can equally make money when the coin is going down. You can equally make money when the coin is going down. So you can make money from both volatility, that's from both change in price. So that's one advantage. And so that's the advantage. And if you are predicting, you are not buying any coin at all, you are not buying anything, you are only betting on the price change. And if you are betting on if you are seeing the price is going to increase, that means you are buying that currency or you are longing it. So if price is going that direction, then you'll be making money. And if on the other hand the price decide to go against you, you'll be losing money. But if you say shorts, and that means you are selling the coin, and if it's going your way, the price if it's going your way, you'll be seeing profit. That means price is falling as you are predicted. But if you begin to go the other way, you start losing. So this is just the full explanation I've done there. Now, what I will talk about now, I think I spoke about leverage yesterday. I spoke about leverage. Yes, I spoke about leverage yesterday, and today I'm talking about margin. I'm talking about what? Margin. Now, margin is, can everyone still hear me? Please, if you are still following, let me know. If you are still following, please let me know. All right, I will just proceed because I can hear myself. I think network is good from my end. Now, margin is simply the amount of your balance. Is the amount of your balance you are allocating to a particular trade. For example, let's say you have a trade of you have a trade of you have a capital of $100. Let's say, for example, you have $100 in your wallet. You have $100 in your wallet, and you only want to use $10 from that $100 for a tight trade. You don't want to use all the money at a time. You want to use just part of it, which is possible. Now, this part of the money you are using is what we refer to as is what we refer to as what? Margin. Now, uh, it's what we refer to as what? As margin. And this margin is what you can now apply leverage on to amplify it. For example, if you are if you are using allocating just $10 of your capital to a particular trade, and you are now applying 100x leverage on that trade, that means your $10 capital will now be working as what? As $1,000. But originally this amount is your margin. That's what will be deducted from your capital once you put the trade. Do you understand? So that is it. That is what margin is. Now we have two type of margin. We have cross margin and we have isolated margin. Now the isolated margin mode depicts the margin placed into a position is isolated from traders account balance. This mode allows traders to manage their risk accordingly. Now this isolated means that this $10 is is the only one you are using for, is the only money you are using for that trade. Once the loss be your trade goes against you and your loss equals to $10, is going to cut it off and close the trade for you. It's not going to touch the remaining $90 in this balance. Do you understand? This $10 is working alone. This margin is isolated. That means it's alone. Is that clear? I believe that's clear enough. I believe that's clear enough. All right. Now, on the other hand, if we are talking about cross, now what cross means that if the trade begins to go against you and your loss go equal to $10, your trade will still keep running. Someone is saying my voice is echoing. Is my voice echoing? I'll proceed while I wait for confirmation. Now, the isolated margin mode. Now, the where is it? Cross margin mode. This cross margin will use all of traders available balance. Now, what this cross means that if the loss begin to go against you and your loss equals to $10, it's not going to close the trade for you. Instead, it will now remove from the $90 remaining in your capital and add to your margin. So your margin will keep increasing. You will be borrowing money from your capital to keep your trade running. Do you understand? So, for example, if you put the trade at $10 and your loss becomes $9 or 9 point something dollars, your margin will become $15. It will remove $5 from this $90 balance to keep the trade running. If the loss go again and increase to say say $14, it will take money again from your balance to keep your trade running, to keep taking money from your balance, to keep taking money from your balance, to keep taking money from your balance. That's all it will be doing until this balance goes to zero. So when your loss reach like let's say 99 point something dollars, that is when they will now cut your loss and close your trade for you automatically. So that's the difference. Isolated, only the margin is being affected in the trade. Nothing touches the balance. In cross mode, the whole your whole balance is used to keep the trade running. I think that's clear enough. Now let's go to the next stuff. Now the next thing we'll talk about is position size. Now this position sorry, excuse me. This position size is simply the product of leverage and your margin. Is the product of leverage and margin, and that's the total amount of money you are using to trade. This means that if you open a trade with $100, you open a if you open a trade with $100 and you use a leverage of 100x, your position size will be 100 times 100. That means you use margin of 100 and you leverage it with 100x. Your position size will now be what? $10,000. 10,000. This means when you open a trade with $100, you use 100x. You are actually trading with $10,000. You are leveraging on borrowed money from your exchange. That means you use just $100, but you have borrowed an extra $9,900 from your exchange. That's what it means. Now your exchange will always protect themselves because if this money should go to zero, there's nobody they are going to hold. They don't know you, they cannot owe you for anything. So your $100 will stand as your collateral. In as far the loss has not gone below $100, your trade will keep running. But immediately your loss, remember you are trading with $10,000 and you're having just $100. Now immediately your loss go below $100, they are going to close the trade for you. I hope this is clear. They are going to close the trade for you, and it means you have been liquidated on that particular trade. So using your original $100 as collateral, once your loss equals your collateral value, that's your initial $100, you will be forced to be liquidated out of your position, and your money is gone forever. So immediately you get liquidated, they will retrieve the money they borrowed you, and your own money is gone for life. I don't know where the money goes to, but it's gone for life. Now, this is the risk involved in using high leverage. Imagine placing a $10,000 trade using $100 form of collateral. Now, if the trade just go 1% against you, 1% of $10,000 is what is $100. So if you are trading for say let's say Bitcoin now, and Bitcoin move just 1%, automatically your $100 has finished. If you move 1% against you, your $100 has finished and you have been liquidated, your $100 is gone forever. So that is why usage of leverage is very, very risky. You must understand how to use it before using it. I hope this is clear. Now, if you are on a cross margin and you're having $1,000 in your profit account, in your future account, and then the whole $1,000 will be used as collateral to keep your trade running. That's another disadvantage. If this is a cross margin that you use to open the trade, and you enter with $100 using 100x leverage, now your whole $1,000 will be used as collateral. Do you understand? So once the price start going against you, your margin will be increasing. Your margin will be increasing immediately. Your margin gets to $1,000 and it gets liquidated. then your $1,000 is gone for life. Now, that is why you must be very careful of leverage. It is a double-edged sword. Until you master your strategy very well, stay away, stay away from high leverage. Until you master your trading strategy very, very well, stay away from high leverage. Now, we'll talk more about this later. We'll talk more about this later. So let's go to the next slide. Now, from our outlines, the next type of trading, we are talking about types of trading. That's what we are talking about. So the next one is DeFi trading. DeFi trading. Now, decentralized finance, pronoun or DeFi is pronounced as DeFi. That's DeFi. Is a novel financial system that operates independently and does not rely on centralized financial intermediaries like bank, credit unions, or insurance firms. Instead, users have the ability to trade, to transfer, trade, invest, transact peer-to-peer, transact. Please, before I proceed, ensure that if you have a question at any point, jot it down. If possible, type it down. If possible, just drop it in the comment section so that at the end of the class, I will not spend time waiting for your questions. I hope that is clear. Just type your question and drop it. You understand? So I will see it there. So another peer-to-peer using cryptocurrency and digital assets via automated smart contracts, eliminating the need for slow and costly intermediaries. This DeFi simply offers every services that bank offers. That's just it. Exchanges also offers these services, but while using exchanges, you are not dealing directly with the customer involved. You are going through that exchange. That exchange is standing as a intermediary, as a middleman. Like if you are staking on Binance now, you are not interacting directly to the blockchain of that coin you are staking. You are interacting with Binance. Binance is not doing it on your behalf. Do you understand? Just exactly how bank is like an intermediary. So this DeFi cancel that intermediary. If you are interacting with DeFi, you are doing staking, lending, and all those things DeFi, all those services DeFi offer. You are not involving any third party. It's just the transaction is happening between you and the direct user. For example, if you are lending on any DeFi blockchain, you are lending the person directly. Now, there's a way the algorithm has been programmed that the person will have a collateral before you can borrow. For example, if I have Bitcoin now, I have Bitcoin now in my wallet, and Bitcoin has dropped. I just want to cite Bitcoin as an example. Bitcoin has dropped in value. Maybe when I bought it, it used to be $10,000. Now it has dropped to $8,000. And I have plans of paying my house rent, and the house rent is exactly $10,000. I need to pay my house rent, and I don't want to sell my BTC in loss. Or let's say my house rent is $5,000, for example. Now I don't want to sell my BTC in loss, and I want to pay my house rent. So I can use that BTC as a collateral and borrow USDT. USD is a stable coin. Do you understand? So I will use the BTC as a collateral and borrow USDT. So the system already have been such that if I fail to pay back the USD I borrowed, it's going to liquidate that USDT for me, that BTC for me. And the BTC must not go below how much I borrowed. If BTC should go below how much I borrowed, it's going to sell it at loss and pay me and pay the person I borrowed from. Do you understand? So nobody, no, there's no middleman at all. Everything is programmed to work on its own via uh, via this decentralized blockchain. That's why we call it decentralized. Another distinct feature of trading is that it expands the blockchain from simple data or value transfer to more complex financial use cases such as trading, lending, yield farming, flash loans, and derivatives. These are the things I just explained. So all these things, if you are doing it through exchange, exchange is standing as a middleman. You are not interacting directly with if you are buying on spot now, for example, if you are buying on spot now with an exchange, You are not buying directly from the user. You are going through Binance. Binance is the intermediary. But if you are buying from a DeFi platform, that means you are buying directly from the user. Do you understand? So it's just directly peer to peer. That's what it means. Now you use them through DeFi blockchain networks like Ethereum, Binance Smart Chain, Polygon, etc. are all accessible through wallet extensions like MetaMask, and only a few parameters need to be changed to switch network. Now, this simply means that to use this blockchain, you have two ways of using it. It's either you add the extension on your what's it called? This way you add extensions. Can you see it on your browser? So you can add the extension on the browser or download the uh the app on your system or your phone. Those are the two ways to do it. You understand, to use it. So that's what this page is saying. Now, this wallet often have mobile application that can be used to access DeFi projects. These applications are wallets with inbuilt. Now, you can also use DeFi applications on wallets, uh, applications inbuilt in wallets. We call them the apps. We call them tabs. If you check your trust wallet, you are going to see it there. If you check a lot of wallet, you are going to see it there. So we call it the apps. That's tabs. That means DeFi applications. You can go there, you can browse on it, you can check any DeFi websites there. You can easily connect your wallet to it and all of that. So basically, there are two major ways to make money in DeFi trading. Now, number one is buying DeFi tokens. You can buy DeFi tokens. Most of this DeFi platform has tokens that you can actually buy when it's low and sell when it's high. Do you understand? And this DeFi, an example of DeFi platform is PancakeSwap. PancakeSwap is a DeFi platform. On PancakeSwap, you can do a lot. Do you understand? You can buy tokens, you can stake, you can lend. They have services depending on the coin you're interacting with. Do you understand on it? So that is one way. And I have already explained to you how to buy coins on PancakeSwap. So you can use the same method to buy from Uniswap and other decentralized exchanges that offers DeFi stuff. Now, the second way is by leveraging on their financial services. For example, if you have a you can buy a coin now and just take it. You can buy a coin now and just lend it out. Anybody that borrows it must pay back and pay you interest. Then you can do farming, yield farming, etc. So I wouldn't go much on this DeFi. This is not a DeFi class, but at least you should have an idea of it. All right, DeFi on its own is a wide topic, and we'll be having a separate course for it very soon. Yes, we'll be writing a course, we'll be having a course on it. If you want to know more about DeFi, you can subscribe to that course when it becomes available. Now, the next type of trading on our list is arbitrage trading. Now, arbitrage trading does not have much in it. It's just you buying a coin. Okay, let me explain it. uh Different markets have different prices for store for their goods, for their products or whatever it is in their market. There are always different prices. For example, if you want to buy yam, you can go to a particular market. One tuber of yam will be 1.5, and you go to another market, one tuber of yam will be 1.6. There are always difference in it. That's how it is also in trading. Different exchanges usually have different prices. For example, Binance will be selling Bitcoin at $16,000, and Kraken will be selling it at $16,020. So there's $20 difference. So you can buy from Kraken and go and sell it to Binance. Do you understand? Since there's this and you make profit of $20. Now, arbitrage trading has potential of being risk-free or risk-free approach to crypto trading world because arbitrage are less exposed to possible of losing money to high volatility. You are not actually exposing yourself to losing money, though you are still exposed, but not very much like somebody trading spot or futures or DeFi. Do you understand? Because you are not holding it. You just buy from Binance and go and sell coin. You are not holding it. So you have reduced your risk factor. But nonetheless, you are still you are still exposed to some risk. It comes with its own unique risk factors, which some are explained below. There are a lot of risk factors, but to the best of my knowledge, these are the ones I brought out, I pointed out as important that you must be aware of. Number one is projects with the same name. Now there are some projects that they have actually the same ticker. There's something we call ticker in crypto. Ticker is the three is the like Bitcoin now. The ticker of Bitcoin is BTC. The ticker of XRP Ripple is XRP. The ticker of Binance is BNB. Do you understand? Like the acronym, like the short form of it. That's what we call ticker. So some coins used to have the same ticker. For example, this some used to have similar ticker and some used to have the same ticker. Like this coin, SIA, the ticker is SIA, and there's another one also SAI. If you are not very calm, you may take them for one another. You may go and buy, you see SIA at $66 and you see this one as $3. You say, wow, this is a lot of profit. This $50, 50% profit for me. You now carry $1,000 and go and buy this SIA to come and sell it here. On getting here, you are not able to exchange it. They say it's not the same thing. You will not even be able to deposit. Let's say you bought this one for finance and you are trying to move it to KuCoin. You will not be able to move it because they are not the same coin. You understand? So that's when you will realize. And selling it back, you will lose some money if you want to sell it back. If the coin is a dead coin and does not have much volatility, you are even going to lose a lot of money. But if it's a coin that is alive, you will not lose much, but you still lose money. Do you understand? That's one risk. Another risk is they can even have the same ticker. Look at this one here. This might seem like basic stuff if you are a trader, but this becomes significantly more worrying and dangerous when you realize there is a number of projects with identical ticker symbols, such as Binance projects called CyberMarks. Look at this CyberMarks now. The ticker is what? CMT. And some other cryptocurrency exchanges also have CMT, but usually stands for Comet. See that both of them are the same ticker, CMT, but one is Comet, while the other one is CyberMarks. If you buy CyberMarks, you will not be able to sell it because it's not the same thing. In fact, the worst part of it is that while trying to, maybe you have bought this on Binance, you are now trying to move it to another crypto exchange. Now you copy your receiving address from this other exchange and put it on Binance and send. That means you are sending a wrong coin to a wrong address chain. Your coin will be lost forever. For example, if you are trying to sell, let's say you are trying to send BNB to BTC wallets. It depends on the coin and the exchange you are dealing with. If it should eventually go through, your coin will be lost because you will not be able to come back. It will just be lost, it will be missing. Do you understand? So that's these are the dangers of this is one of the danger of trading arbitrage. Now another one is high deposit and withdrawal fees. Now sometimes there are some exchange used to have a lot of a very huge fees. So such that by the time by the time by the time you withdraw, say let's say you buy from Binance, you buy Bitcoin from Binance, the fee is 0.00085 BTC. That's the fee. Now you bought from Binance, you withdraw it to Hotbit, Itbit, and they charge you this. If your profit is not much, this might even cover half of your profits. Do you understand? In fact, it can even cover all your profits, but at the end of the day, you see that you will not be making any profit. If you are not buying much, let's say you are just investing, you are just using $200, and $200 is just giving you like 0.00004 BTC profit, and the fees is now showing 0.0008. That means the fees even more than twice of the profit. So this, if you did not pay attention to it, you just discover that after doing the transaction, you end up in loss. So you must pay attention to the fees. Make sure that the fees is not too much. The withdrawing fee is not too much. Then lack of volume. This is the biggest danger in it. This is the biggest danger. If you should go and buy a coin, maybe you buy a coin from Hotbit because it's cheaper on Hotbit and you want to go and sell it on Probit. After buying it from Hotbit, you now get to Probit, you now discover that there is no volume. No, having no volume means that nobody will be interested to buy it. Yes, the price is high there, but no one is interested to buy. You just put your pending order. When you click buy, you just go and stay as pending order and it will be there forever since there's nobody willing to buy it. You just be on the order book. Now you may now say, okay, oh, I want to return it back to Hotbit. Remember that you spent withdrawal fee withdrawing it to Hotbit. You will now spend another withdrawal fee withdrawing it back to Outbit. Do you understand? Withdrawing it back from Probit to Outbit. That means you have spent withdrawal fee twice. Now you might now get back to Outbit and you eventually see that there's still the same problem. On Outbit, there are no buyers too. Now you have already lost from paying withdrawal fee twice. Now getting back to Hotbit, nobody's willing to buy. The value of the coin has dropped and nobody's willing to buy it from you. That's double loss. Your capital is gone. You may not get that money again. The coin will just be there useless. There are coins that have been useless for a very long time. When it gets some point, the exchange they will remove it from their platform. Once the exchange remove it from their platform, you must look for where you will withdraw it to before the exchange remove it. Because if they should remove it on you, that the loss is on you. So you go and look for another wallet that you can use to hold it. Since exchange is saying they are no more dealing with that coin. That's double loss for you. Very, very huge loss, depending on the capital you used. Can you see that the arbitrage is not risk free? Now the next one is pump and dump schemes. This is another very bad. Yes, there's something called pump and dump in trading in crypto. Now what this means is that I will create a coin. I will create a coin. I'm the one that created it. I will market it with my team. Then after that, we will now buy it. We'll buy it with our own money to lure people into it. We'll now place it, we'll put it on sales order such that when newbies come and they buy from our sales orders, nobody will be willing to buy from them because it's just like we created it and we put it on the exchange. Now we'll be the one to pump it. Yes, we'll be the one to pump it. And once people bought it, the coin will automatically dump because this thing deals with what's it called now? It deals with supply and demand. It deals with supply and demand. When people are willing to buy, the price goes up. When nobody is willing to buy, it's the thing that was buying before when the price was going up. Immediately you came in and you bought from us, we will stop buying, and everybody that bought from us will now be willing to sell. They will be setting sell order, sell order, sell order. So those sell order will force the price to go down because price will try to go down to where there's liquidity, to where people are willing to buy. If the price of an asset is too high and people are setting their sell orders, it will keep dropping and dropping. Nobody is willing to buy. It will keep dropping to where people are willing to buy. So no, we are the one that put the coin there, up there, and people have already bought from us. Do you understand? Now nobody is willing to buy anymore. The price will keep going down and down and down and down and down. So that's why you see a coin do like 800%, and the next minute it does minus 85%. That's pump and dump scheme. So if you fall for that kind of a coin, you are in trouble because there's no how you sell it. Nobody will buy it from you. Now the next one is timing. If your timing is not perfect, you will still lose money. That's it. As simple as that. If your timing is not perfect, you will still lose money. What does this mean? You buy a coin, you want to go and sell it on another exchange, and your network is now very bad. And in the process of you trying to put it on the other coin before on the other exchange, before you were able to withdraw it to the other exchange, the price has already dropped. You will lose your profit. So that's why we say timing. You must have good timing. Do you understand? So I think that is all on that topic. Then the next one had this stuff, these guys here, pre-sales, private sales, IDU, ICU, IEO. There are a lot of them. You can browse about them. There are a lot of them like that, and all of them means almost the same thing. And these are their definitions here. A pre-sale is practice where assets are made available for purchase to selected customers before an advertising selling date. Sorry, an advertised selling date. Do you get it? It's just like a way in which they raise fund, like a pre-sale. You get it cheaper when you buy it before they launch it. You buy it before they start selling it, and it's made available for selected customers. Not everybody can buy pre-sales. There was a pre-sales I bought last year. We have to do what's it called? We did one task like that to be able to qualify. So they whitelisted our exchanges. Those of us that were qualified, that's why we're able to buy it. Do you understand? So we also have ICO, that's initial coin offering. Is the is also related to IPO, a company seeking to raise fund. Now the difference, it precedes that they have the product on ground, but they are selling it to you at a cheaper price ahead of the time of launch. But this ICO, they don't have the project on ground, they just have the blueprints, they have the idea and all of that. So they will now sell it out to people to raise money. Do you understand? Just like I want to create a platform. I want to create a platform that can connect all, let's say, all artisans together, such that any kind of handwork job you want to do, you just go there. You want to wash, you want to sew clothes, you go there to tailors page. You see a lot of tailors close to you. You can pick anyone. They will come to your house and sew your clothes. You understand? If it is mechanic side, you go. If your car is having fault, so I want to create that platform. I have the idea. I have the blueprint, but I don't have money. So I can create a coin that, okay, this coin is what we'll be using to make payments on this platform. And since the idea is unique, that means once people start using the platform, they'll be forced to buy that coin, and the price of the coin will definitely go up. So all I have to do is calculate how much I will use to finish to do the platform, then create a coin and sell it out, so that from selling that coin, I will get the money to do the project. So when I'm done with the project is live, people begin to use the coin. They will have to go and buy from those that bought the ICO, or maybe there will now be limited supply left. So the price will go up fast. The price will increase fast as people begin to use the platform. That's ICO. Now we have private sales, is an early stage investment round for strategic investors with a considerable amount of investable funds. So this one is almost related to pre-sales also. You it's not anyhow investors. Like this one, they need huge money. They need people that will invest millions, billions, not small investments. No, there's a considerable amount of investable fund. There's limit what you can invest. And then we have IDO, or initial DEX offering. Is a way of amassing financing, a relatively new fundraising model that follows the success of the five IDO. Now, IDO is the initial offer of coins on the centralized exchange. So they initially offer the coins to you on DEX before it now has it now has it now become popular. Like it's just also a way to raise funds, just like ICO, but this one is being done on decentralized exchange on DeFi. Do you understand? You buy the coin, like Presale I said I bought the other day can also be likened to DEX because when I bought it, it was newly not DEX anyways because I didn't buy it from the DEX platform. I bought it from their website. So if you have a question, you can drop it. So that is it. These are also form of exchanges. And before you can invest in this kind of stuff, you must apply the fundamental. And in fact, all these things we have been talking about, pre-sales, arbitrage trading, and DeFi trading. For you to trade them, you must apply fundamental analysis. Most of them don't used to have plain enough data, so you can't even do technical analysis on them. You have to do fundamental analysis on it. So that this is the end of this particular topic. Our time is fast spent. I won't start a new topic. This is our next topic. Um, Introduction to technical analysis is going to be a big one. Talking about a lot of things, but we'll start from risk management because personally I believe that this is the bedrock, like this is the foundation of any trader. If you don't like this like your what can I call it? Like your life support. Yes, this is like your life support, risk management. This is what will make you stay long in the game. If you don't apply risk management, you can flip $100 to $10,000 in 1 month, and the next 2 days you will take it back to zero naira. If you don't have risk management, you need to have a risk management plan. So that is why I start with it, risk management. Then we'll do some light introduction like candlestick, trade size, margin trading, key theory, talk about some theories. Then we'll now go to support and resistance. Then I will now talk about trading mindset. There's this thing about trading. Analysis is just 80%. In fact, I can say analysis is 90 is analysis is just 10% of your trading. It covers 10% for your success probability, just 10%. The remaining 90% is your mindset, your psychology, your risk management. These are the things that will determine your success or failures. Do you understand? No matter how good your trading system or trading strategy or analysis is, if you do not practice these things, if you don't have the right mindset, you don't practice risk management, you cannot survive. So that's why I'm starting with this topic. It's going to be long topic. After this, we'll start drawing those lines, those things you see on my status. But this is the first topic, and this way we'll be ending the class today. Now, let me check for questions. Godwin Chiuke says in DeFi, when I borrowed, do I place a time limit? Yes, it depends on the kind of borrow you do. There are some that does not have time limits. I don't think there's any that doesn't have time limit. I don't think. The ones I know are the ones that actually it depends on the platform, sha. Most of the time it used to have time limit. It can be 90 days loan, it can be 30 days loan, but some does not have, some are like perpetual. In as much you are the interest is accumulating, and both the interest and your and the money you borrowed, the asset you use as collateral does not go below the amount you borrowed. It will just keep, the interest will keep increasing. You keep I've not actually done it from decentralized exchange, but I do it on Binance. There are some times that I will want to trade on futures and I have Ethereum. I may have, like, let's say I have one Ethereum and I want to trade on Binance. I don't want to I don't have any stable coins, I don't have USDT. I can use my ETH as collateral. It's very easy. I use my ETH as collateral. I can use like 0.1 ETH as collateral to borrow like 200 USDT. So if I'm not able to pay back, that's where the problem will come back. Will come, sorry. But all the every I always pay back. That's it. That's it. I've never done it where I didn't pay back, and there's no time range on it. The interest just keep increasing and increasing. If I borrow for like a week now, the interest will be very very massive. So most of the time I just borrow, raise the capital, then start trading. Do you understand? I've done it once or twice. Then later on I can use the capital to buy a stable coin, an altcoin for profit. That's how I do trading on I do trade on Binance. Do you understand? So there's no limit to it. There's no time frame to it. But the interest keep increasing, and I will make sure that uh, I don't my loss does not go, because immediately I borrow they will lock the ETH, and maybe if I don't know, there should be time frame. I've not really put mine because I pay it on time. So, but I think there should be, if it's a decentralized exchange, there should be time frame. Should be time frame for you to return it. Then if you fail to return it at that point, they might liquidate you or something. Do you understand that? Now the next question says, how will you know an exchange? How would you know an exchange wants to withdraw a coin? It's not the exchange that will withdraw a coin, oh, it's you. If you have a coin on Binance now, you want to take it out of Binance, you are withdrawing it out. So if you click on withdraw, that means you are taking the coin out of the exchange. So it's you taking the coin out of the exchange, not the exchange taking the coin out themselves. Do you understand that? So, okay, this one is saying Bradford Walter says names of the five platform. Just browse about it. There are a lot of them. There are a lot of them. PancakeSwap is one. You understand? On Trust Wallet. There's Uniswap. A lot of them. Just browse about it. You see them. How will you know if I've answered that one? Why some developers do lock the coin on ID or ICO? Yes, the lock is so that you're not able to dump it. For example, there's a coin I was not able to buy it because the procedures were very very hard. There's a coin they bought on one of the groups I am. Now to buy that coin, you must take another coin, and that other coin that you must take is around $10,000 before they can give you this coin that you are buying on ICO. Now, this how they they will release the coin to you. It's only 25% of that coin they will release to you. 75% will be locked up, and after 6 months they will now release half of that 75% again till another 6 months before they now release the rest. Now the reason is that they don't want to come and sell it all, because once you, let's say you bought the coin at $20, and now you bought like 10,000 pieces of the coin at $20, and because it has now done 1,000%, a lot of people bought it, you now say you want to sell all your coin, it's going to affect the price. So they will not allow you to do that. They will put time frame to it that they will lock part of it up so that you cannot. So they do that basically to avoid dump, massive dump. That's why they lock it up. Now, someone say you were about to do an example on how to trade futures yesterday, and you have still not done it. All right. I have a video on my channel that I will recommend to you. I can't go through it. I'm sorry. So the video is self-explanatory. When you watch the video, you understand how to do it. And if you have questions, you can drop it on the group chat. Have I answered everyone's question? If I've answered your questions, please reply. And if you still have confusion, let me know. I'll wait for 2 more minutes. Take that. All right, I think everywhere is good. No one is saying anything. No one is saying anything. To me, I will take that as no more questions. And if you are still typing, okay, Waris is asking which exchange is good for spot and futures. There's no good, there's no bad. It depends on the one you want. I prefer to use Bybit, Binance, and those are the two I use. Yes, I'm comfortable using them. That's it. I think FTX is also good. FTX is good, and those are the ones I use anyways. I can't talk about what I don't use. All right, that will be all for today. Thanks for your time. Thank you for coming, and see you all tomorrow. And please let's try as much as we can to be punctual for tomorrow class. Good night, everyone. Have a nice day.